Welcome to Friday's Financial Fitness. Last week I gave you an example of a company buying their stock back. Today I want to finish our three-part series of the effects of the companies that do in fact buy their stock back. If you recall from last week, when they bought back 30 million shares, their earnings per share had gone from $1.80 per share up to $1.95 per share, and we were using a stock price of $30 per share. One of the concepts that investors look at is this concept called price earnings ratio, or better known as the PE ratio. What the PE ratio does is it takes the price of the stock, which in this case is at $30 per share, and it simply divides it by the earnings per share. And again, in this example, it's $1.95. And so if we simply take the price, divide it by the earnings, hence the name PE, we come up with a PE ratio of 15.38. Now you may actually wonder, is 15.38 a good number or a bad number? And that depends. Let's assume that the stock went all the way up to $40. It jumps from 30 up to 40, and the company still made $1.95 per share. Our PE ratio then would go from 15.38 all the way up to 20.5. Normally, investors that look at PE ratios tend to want the PE ratio lower, as this indicates a lower price of the stock relative to how much money the company is making per share. According to Robert Shiller's book, Irrational Exuberance, the historical PE ratio for the Standard & Poor's 500 has historically been 14.7, going all the way back to 1870. In summary, now you can see why a company may want to buy their stock back, as their earnings per share may move higher, that may ultimately bring down their overall PE ratio, that may make them more attractive to investors.